Hello everyone, my name is Nikolas Pugatchenko. I'm going to be talking today about active versus passive management in retirement planning. We're thinking about a retirement planning situation, could be 40 years, a long time horizon. Kind of all other things equal, we're going to see the differences between an actively managed mutual fund, a passively managed index fund, or an ETF. In the same exact tax-deferred account, let's say both invested in the S&P 500, just to make things simple. Even though I'm sure everyone remembers what passive and actively managed funds are, we're just going to kind of go over a couple things to just to get a little refresher. Now, when we're talking about passive management, we're talking about a fund that's designed to automatically mirror a specified market index. And so there's no stock picking going on. There's no finding certain stocks that are valued differently than others that you can, make a profit from. It's kind of more along with the efficient markets idea that all the information is available. No one can can outperform the market, so to speak, because the second information is known to them, it's known to everybody. So, there's stronger and weaker forms of that argument, but the passive management will just say is more on the efficient markets side of it. It's not going to track whatever index it's trying to perfectly, so the tracking error can be an issue. An example would be, for gold, there's the GLD, is the passively managed ETF index fund for gold, and you can look at actually a chart for the commodity and the GLD. It can be somewhat similar, but it's a little bit different because that's a commodity. With the S&P 500 and the SPY, which is, I believe, I don't know if it's iShares or I think that's a spider actually, which is meant to mirror the S&P 500. That if you look at a candle chart, they look very similar, but the ranges are not exact because there's a little bit of a timing lag. The passive funds are meant to adjust according to that ratio automatically. And if there's a little bit of a timing lag or where the actual trades are made, the size of the trades that they can get in, they can't never be totally exact, but it's very close. There's no human being on a daily basis doing analysis trying to find market imperfections and profit from that. So it's a lot lower expenses because you don't have to do all that analysis. It's economies of scale. It's a lot of money, all kind of investing automatically and going in and out. So. Much lower expenses in general. We're talking about active management. We're talking about your typical mutual fund where each fund has an objective stated in their prospectus according to regulations, and they have to manage the fund according to that objective. So it could be to outperform. It could be a bond fund to outperform the 10-year Treasury. And there's one called the TLT. Actually, the TLT would be the ETF, but there's many different bond funds, Treasury aggregate bond funds, MSCI, the Morgan Stanley Composite Index. They have many different indexes on pretty much every sector, every geographical area, by market cap, asset classes, as far just almost everything. There's even one called. They're specific as social media stocks in South Africa. That could be a mutual fund. But there's a human element, it's either one person or a team of people that are constantly working, doing analysis. They don't need to buy every stock in whatever index. They only need to find the best stocks that are going to outperform that index. So it's really a stock picking type thing. And you get what you pay for what you get, I should say, with all that time. There's sales loads, there's a bunch of different costs, which I'll kind of compare in a second for you. But one other difference, really, ETFs or index funds, which are passively managed, trade like stocks. So you can trade them throughout a trading day. You can short sell those. There's options on them. There's even futures on some of them. And you can get whatever, a different price at any second throughout the day, whereas actively managed mutual funds, you can only buy them at that day's closing net asset value, so you can't really trade them, so to speak. It's more of an investment vehicle. There's been some past studies on the subject. William Sharp We went to the Sharpe ratio, started examining this topic in 1966, and found that it was worth looking into, basically focusing strictly on the cost differences. Eugene Fama and Merton Miller in '72 found that a technique to outperform the market is impossible in the long run, or whatever that benchmark may be. It may be possible to find a strategy that will work for a shorter period of time or a few years, but it's just never been done consistently in the long run. So then in '85, DeBont and Thaler found that it's very difficult to maintain exceptional 3 to 5 year return. So even some of the top managers, they might have a 3, 5, or 10-year record that is outstanding, but after that, it's kind of like a mean reversion potentially, and there's many other things going on, but it's just very difficult to keep that level up over time. And then Edlin, Evans, and Cadleck in 2006 did a study and found that active management, all other things equal, sees an annual performance drag of 144 basis points versus their passively managed counterparts. And there's many other ones regarding this specific topic, but Haslam in 2012 found that it was actually a 99 basis point performance drag. But what are these different costs? So for actively managed funds, which you'll see that the costs are higher. Different costs are expense ratio, which is really just for operating the fund, paying the management team for all their analysis and hard hours that they do, and all of that stuff. They have to travel. If they're managing a China fund, they have to travel to China, meet with CEOs, probably on a private jet. But you never know. Anyway, for actively managed funds, that is 112 basis points right off the top of your return. And for passively managed funds, that's 60 basis points. So that's a 52 basis point advantage to the index fund. The next category would be transaction costs, which is simply really paying trading commissions as you make trades, which to a broker, to the exchanges, to the data vendor to get the quotes. I mean, there's a lot of different things that go into it. And that's 50 basis points for actively managed funds and 0 for passively managed funds. Which is not really 0, it's just so close to 0, it's probably maybe 8 basis points, something like that, so 0.01%. But overall, that's a 50 basis point advantage to index funds on that as well. Cash drag. Now, all funds have to have some cash available to be ready to buy the next thing. As I mentioned, passively managed funds have to be invested in the exact ratio to that index. So they're just it's constantly doing trades. If they have to liquidate whatever has to be liquidated, just like the S&P at that exact moment, and buy the next thing. Sell one thing, buy the next thing, an exact proportion. Where in an actively managed fund, you have to have a certain amount of cash on hand for sure, just in general. That can't be invested in anything except cash, but you need to have cash available to, if a security comes down in price or it goes to a certain price, you have to have cash ready to buy. You can't just liquidate another position that you might have been waiting for, months for it to make its move and just give up on it to free up cash to make another purchase. So while that cash, you're holding that cash, it could be invested in stocks and you're losing out on that equity premium. So the cash drag for actively managed funds is 15 basis points, and for passively managed funds, it's 0 because they don't have that problem. Last category is regular sales charges and fees, which would be like a sales load type thing. Many mutual funds, they used to have they call them A shares or C shares, which is basically a front load or an end load. So let's say you put 100,000 into, let's say, an Under Armour. All right, now let's talk about a mutual fund. You put it into an athletic shoe fund following an athletic shoe index. So it's got like Under Armour, Nike, random stocks like that. You put 100,000 in that, you're going to have to pay maybe 2,000, if you used to anyway, off the top in the sales charge. Or not pay anything, but if you take money out, you have to pay that back end percentage, which could be 200 basis points, it could be 600, it could be less. It was just very variable. But in the end, we're looking at total expenses for actively managed funds dragging down performance by 227 basis points versus for passively managed funds, it's only 60 basis points. So that is 167 basis points an advantage for index funds. That if all other things equal, that's pretty impressive. I mean, that means actively managed funds on the whole would have to earn at least that indexing premium, if you will, over the long term in this retirement plan situation. So, but speaking of what has been better, there's been so many studies on that as well. But active management as a whole, most of the managers underperform their index, which means they've essentially failed in their job. But the very small that do are very sought after. And then you have to think about the different types of markets and how they do. In a bull market, and it depends on the type of bull market, but we've had such a strong bull market for the past 6 years with all the Fed stimulus and everything that it's just been hard to keep up with the indexes that all these active managers are trying to beat, because some of them are hedged, some of them, they get some leeway in how much risk they want to take. They're not fully invested necessarily. In a flat market, it could be either or really. And in a bear market, it's been talked about that active managers do a little bit better because they have more freedom, they can be hedged, not be fully as risky as the index. But that's kind of all still up in the air and just something to think about a little bit. But, on the whole, it really seems, all other things equal, that is, that if you just want lower cost, you don't want the headache, put your money, find some asset classes, be well diversified, and put them in an index fund. And you're going to be saving yourself about 167 basis points over your life. So here's some references which you can look in on. And with that, thank you very much for listening. Any questions, you can certainly email me or give me feedback on Blackboard. So thanks a lot. Have a great day, everybody.